feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place.
A typical bubble works in 4 distinct phases. It begins with the initial phase, also known as stealth phase, where early investors recognize the opportunity and start buying quietly. Then comes the awareness phase, as institutional capital begins to enter and prices start rising more steadily. Next is the mania phase, marked by extreme enthusiasm, heavy media coverage, and explosive returns. This is where the bubble truly forms. And finally, the blow-off phase, when investors are fully convinced that prices can only go higher, but the asset instead puts in a major top and crashes, creating a lot of financial pain in the process. Going back to the 1600s, most bubbles tend to last anywhere from 1 to 5 years. The earliest recorded bubble was the tulip mania of the 1600s, when tulip bulbs in the Netherlands became so valuable that some sold for more than an entire house, right before tulip prices collapsed almost overnight. That bubble revealed how social contagion, leverage, and new financial instruments can fuel speculative manias. And we've recently seen similar forces at play with Bitcoin through the rise of exchange-traded funds, leveraged funds, and treasury companies. In fact, academic research has found that one of Bitcoin's characteristics is to display bubble-like behavior in each bull cycle, with the 2017 bull run being a prime example that showed the 4 stages of a typical bubble. Today, on one hand, Bitcoin is seeing widespread enthusiasm, heavy media attention, and the kind of public optimism typical of a mania phase. On the other, long-term holders have been selling, and price action has been choppy, suggesting the early stages of what could become the blow-off phase.